So looking forward to this, Carl. Going to be going through a lot of questions from subscribers.
Fantastic.
Here we
and
are.
I think we're streaming live. So
looking forward to this, Carl. Going to be going through a lot of questions. Cool. So make sure. So I'm muted on stream. We're good to go. Let's do this.
Okay, let's go. Happy Friday.
Happy Friday, guys. Adam Markley here. Carl Allen joining me. We're really excited to do this live reader mailbag. Ask any questions you can below, but looking forward to getting through the list that you guys sent in. Not the first or last time we'll do this, so looking forward to answering your questions. It's going to be a little bit of a speed round with Carl and I, banging through things. So happy to get things going. You ready to rock, Carl?
Ready to roll.
First question.
Let's do this.
All right, great. Carl, Jonathan has written in and asked, it's kind of a multi-part question, but what businesses should we focus on acquiring with everything that is going on in the economy and the coronavirus? We've gotten a few questions like this, Carl. So kind of speaking big and broadly, what do we think? What do we think?
I would definitely avoid the travel industry for a start. But then, in my opinion, most other sectors can pivot and not only survive the coronavirus situation, but also thrive from it. Obviously, anything in transport and logistics is going to be huge. Those businesses are booming right now with all the different volumes of products and services that are getting pushed through the supply chain, like food and medication and toilet roll and hand sanitizers and all that stuff. All that production's gone through the roof. Anything in manufacturing and engineering is going to be huge. All of those businesses are pivoting both into all the different governments around the world. They're now ordering lots of more medical equipment to be built to deal with this pandemic. So tons of manufacturing businesses that I know are pivoting away from what they normally do, and they're helping as part of the supply chain for medical equipment and all those different things. But then even if you're not doing that, large corporates, they can't outsource stuff anymore to the Far East. Those supply chains were severely limited several months ago. So everyone's now sourcing from home. So the manufacturing and the engineering sectors are beginning to grow. And, you asked this question the other day, is it the best time or the worst time to buy a restaurant? I'm seeing lots of restaurants, especially small individual restaurants, pivoting and extending a lot more kind of delivery services and really thriving. But we're hearing a lot of the big chains like Cheesecake Factory in the US, Carluccio's in the UK, has announced they're about to file for bankruptcy, because those big companies, they're so highly leveraged and they're trying to grow. They've got thousands and thousands of locations. They're just running out of cash a lot faster.
Right. And I think you mentioned it, what I've been talking about this week with some people is that it's the best of times, it's the worst of times, right? Is it the best time in the world to buy a restaurant or the worst time in the world to buy a restaurant? And a restaurant's just an example of a stricken industry, so to speak, right? Valuations will never be lower. No. There's plenty of blood in the streets for many. So is it the best time or the worst time? Valuations will be low, prospects will be low, distressed sellers will be high. So it could be best of times, worst of times, and I think for those who are seeking opportunity, it's a pretty interesting time indeed. So
absolutely, and I think one of the other big kind of macro changes that you're going to see is you're going to get a lot more business owners wanting to sell their businesses in the next 3 to 6 to 12 months, and that's not necessarily because their businesses are struggling. What motivates sellers more than anything is fear. And we know there's 10,000 baby boomers retiring every day, and almost 20% of them own small businesses. So you're just going to get so many more businesses that come to market. And I think now is the best time, probably in history, to be making offers on deals that are either 100% seller financing, or in a lot of cases, you're putting earnouts into the deal structures as well. So I know we had a lot of questions on asset financing. I think the vast majority of deals that are going to get closed in the next 6 to 12 months are going to need very, very little to, in some cases, zero asset financing to make closing payments.
Yeah, and absolutely, and that was that dovetailed into Jonathan's second question here. And do you think banks will pause asset-based lending?
So no, I don't think they will. We've seen interest rates later over the past few weeks. They're practically zero, and we know that banks only make money when they lend money. We deposit money into banks. They've got to mark it up and they've got to lend it out. So I don't think they'll change that. I think the SBA might slow down a little bit. I know one of the banks that we normally use, they're diverting all of their acquisition financing more into the kind of business rescue loans. But traditional asset-based lending on real estate, on plant and equipment, on inventory, and on accounts receivables, no, I absolutely don't believe that will dry up at all.
Yeah, and I think everyone's potentially going to take a collective breath, where they're going to try to make sure they understand the pivots that are going on. And looking forward to seeing how they themselves navigate. I've been on the phone with banks a lot in the last week or so, trying to figure out where their mindsets are and what they're thinking about. So happy to relay that information to you guys. But I agree. I think long term, this isn't really going to be too much of an impact on the lending side. If anything, because of the stimulus packages governments around the world are putting together, the drop in interest rates, I think we're entering potentially into a very, very kind of unicorn type situation as it comes to the opportunity to buy.
Absolutely agree. And my advice to somebody would be go find 10 deals, build unbelievable relationships with those 10 business owners, really empathize with the situations that they're in, and make 10 100% seller financing offers, and I bet you one will get accepted if you've built the right relationship.
Yeah. Oh yeah. And we've got a couple questions we'll go over today that tie right into that relationship. So looking forward to getting there. Carl, cool. Next questions. We'll kind of jump through these. This is from Eric. And Eric's questions tied to literally Natasha asked the same, Kelly asked the same. There's a few people all asking the exact same thing. And so we'll kind of hammer through effectively one swoop, all three of their questions. How do you identify a distressed business? How do you, are we launching any programs on distressed deals? What are the red flags that would indicate not to buy a distressed business? What are signals a distressed business can be turned around versus not be turned around? So there's a whole series of questions from Eric, Natasha, and Kelly that all tie to distressed businesses.
Yeah.
So I don't know if we want to work through some of those one by one, but first of all, how do you identify a distressed business? I think categorically, that's the 101 level, and we can narrow in from there.
So I think first of all, let's distinguish the difference between a distressed business and a distressed seller. So what we do is we buy good businesses from distressed owners, people that are highly motivated to sell. They're either sick, dying, want to retire, burnt out, frustrated, run out of ideas, doesn't matter what it is. That's the perfect deal to buy, in my opinion. A distressed business is a business that's in some trouble. So it's either run out of cash, customers are fleeing in droves, or key employees are fleeing in droves, or they've had some major reputational damage inflicted on them, or a large kind of external lawsuit. So for me, I wouldn't buy a distressed business unless I had an existing healthy business to bolt it straight into. And the reason for that is, if you buy a distressed business as your first deal, you've got to have really kind of turnaround chops and a real kind of ballsy mindset to want to get into that business, roll your sleeves up, get stuck in, and do a lot of really hard, painful work to turn that business around. Yeah, you can buy a distressed business for $1. I've done it. I gave it back after 6 hours. I couldn't stand it any longer. What an absolute nightmare. I'd rather spend my time buying good businesses from distressed sellers. So if you own a business already, let's say you're in the manufacturing space and you find a distressed manufacturing business, then that would be a good business to bolt into what you've already got, because you've already got the cash flow and the team to be able to quickly absorb it, integrate it into what you've already got, and almost do an instant turnaround. If you haven't got a business already in that space and you go and buy a distressed business, you're going to be in that business 14, 16, 18 hours a day, really trying to turn it around. And I think that there's a better use of your time finding a better business and either doing 100% seller financing, which I think is a lot more possible now in the current market, or if you need a little bit of a closing payment, use the surplus cash in the business or go raise some financing secured against the assets that are in the business already.
Yeah, and I couldn't agree with you more on that. I think distressed deals as bolt-ons or part of a bigger roll-up are perfect. I mean, I look at the kind of really big deal you and I are working on now here in the States. We're going to close this foundation company, and we immediately have a distressed company to roll in, and we're going to see roughly 800 grand worth of day zero savings, because we've got a better infrastructure and a better kind of operations team in place for the first business that will just plug right into the second. We'll save a ton of money on the operations expenses, and all of a sudden now we've got a much bigger business where we've effectively added good assets, good employees, and good clients without any of the bad of the distressed deal. So distressed sellers, not distressed businesses. All that said, some people are going to do distressed deals. I know I just talked on Sunday to a student of ours who has done a distressed deal, and he did it using your distressed deal training as part of the bigger Dealmaker CEO program.
Yeah.
And so he's done it, and he's living it, and he's getting through it. So they aren't all bad, and it's not all a no-go. It's just not something that you or I maybe would prioritize for our first deal. But what we say to people is, once you've done one deal, good, bad, or somewhere in the middle, you're always going to be in a better place to learn. You've effectively learned 85% of what it takes to do this, and the rest comes from more and more deals. But
yeah, I think
process.
One of the key questions that you would need to ask yourself before going down the distress route is, do you want to be an owner manager or an owner investor?
Right.
So Adam, you and I are owner investors. We own multiple companies on different continents. We're not working in any of our businesses. The problem with a distressed business is you can't really be an owner investor because the business probably doesn't have the cash flow for you to hire a GM to come in and fix it. So if you want to be an owner manager and you've got those detailed, rigorous kind of turnaround chops, and you've got kind of nerves of steel, and you're prepared to go in there and work really, really, really hard to take the business by the scruff of the neck and lift it up off the mat, then you can make money from distressed businesses. You absolutely can. But it's not the way I do deals. I know it's not the way, Adam, that you do deals. That's why I don't like them. But I know that some people that are a lot more kind of turnaround focused than I am, they have gone in, picked up businesses for $1, turned them around, and they've sold them and they've made some good money. So if that's how you're wired, definitely go for it. But still, if you're going to do a distressed deal, stay in your lane. Don't go and do a distressed deal in an area you don't know and you understand, because how are you going to turn it around? If you've spent your career in manufacturing, go and buy a distressed manufacturing business, because you will know how to quickly add value and turn that business around. You wouldn't go and buy, if you were a manufacturing professional, you wouldn't go buy a distressed hotel. How on earth would you understand how that business works? And you might have days to rescue it. So if you're going to do a distressed deal, stay in your lane. Okay, Adam, I think I got a question for you. You've frozen a little bit on me, so I'm going to ask the question. I'm working on finding a broker. This is from Aaron. I'm working on finding a broker to help me get started, but so far no one is willing to work with me as I can't pull together much of a down payment. Is there any reason a broker would be averse to seller financing?
Yeah, I mean, the first reason a broker is going to be adverse to seller financing is how are they getting paid? And in a seller financing, say it's 100% seller financing, you're doing no closing payment or anything like that, it's going to be nearly impossible to fund the broker. So you've got to pull them into the negotiations, right? This is a situation where you say, hey, broker, you're going to make, say, $50,000 from this transaction or $100,000 from this transaction. Say it's $100,000. Listen, instead of me paying you $100,000, I'd love to pay you 120 grand. They're going to go, great, I'm going to make 20 more grand from this, but I'm going to need you to let me pay for that over the next 2 years. So you're going to have to defer it, maybe 3 years, right? And the idea is you can go to the seller and say, listen, seller, I'm going to pay your fee for you. And you just build it into your offer. And then to the broker, you're saying, listen, I'll pay for the fee, but can we work out a deal where I'll pay more, spread it over time? It's called cash flowing the payment. And effectively what you're doing is you're taking the business and you're allowing it to do the work for you to generate the free cash flow and cover it.
And we're doing that on a deal right now.
Yep. So it's often, again, we think about creative deal making, right? You've got so many things in the quiver, if you will, or bullets in the gun, whatever your kind of a metaphor is. But the idea there is we've got closing payments, we've got seller financing, we've got bank financing, we've got asset financing, we've got equity injections, hard money loans. You've got all these different ways you can contort and structure a deal. And the more you understand and truly figure out what the right puzzle piece is for the hole or gap that's left, the better you'll be. And the way you do that, simple. You got to understand what your seller wants. You got to understand what their goal is. Carl and I talk about this all the time. What is their motivation? What are they looking to do before acquisition, during acquisition, and post acquisition? What is their goal, right? We were talking to some sellers. They want to sail around the world in 3 years. That's their goal. Great. What's it cost for the boat? And can I make sure they make enough money to go pay for that boat plus get some income, right? How can I structure a deal where I'm thinking about what their needs are, right? I think back to the company you bought a couple of years ago, Carl, in California, where the seller just wanted a vacation. That's all they wanted. So you paid for a vacation and saved yourself, I don't remember, 100 grand on a closing payment, 200 grand on a closing payment, because all they really wanted was enough money. They just wanted enough money to go on vacation. So when it comes to seller financing, at the end of the day, it's all about understanding what each party involved wants. We know brokers want their money up front. Their fees are generally a percentage of the guaranteed sale. What that means is if there's an earnout, it doesn't apply to the broker fee. And so whatever that amount is, they're going to want that money. And you've got to treat them just like a seller in how you negotiate with them, how you build a relationship, things like that. Again, we're not looking to take advantage of everyone. We're just trying to make sure everyone walks away a winner and everyone walks away feeling like they got the desired outcome for themselves.
Perfect.
Again, this isn't manipulation. This isn't cons. We're trying to help sellers go from their current ownership position to the next stage of their life and do it in a way where we can support that transition. And any intermediary along the way, we want to take care of them in the best way possible. I just want to give people a shout out. Real quick, we've got some people asking questions, so thanks guys for doing that on YouTube. Carl, we got a guy, Austin. He's asked you what beer you're drinking, so that's an easy question.
So I'm drinking BrewDog in my BrewDog glass because
there it is.
It's 5:20 on Friday in the UK, and I've been locked in the house all week. So
it's 5 o'clock somewhere.
I'm having a well-earned beer. So let's keep on with the questions, Adam. So Brian's asked, I would like to know if you have a mentorship program.
Yeah, so Dealmaker Wealth Society does have a mentorship program. It's called Dealmaker Academy. It's group coaching on a weekly basis. You'll have me, you'll have Carl, you'll have a couple of our top coaches in there. And every week, it's training, it's teaching. We just yesterday. Yeah, and we look at deals. So we do something called red light, green light, which is really cool. We go through a couple of deals where it's anonymized information. They're actual real deals that either Carl's working on, I'm working on. Prox, our private equity firm, we're working on it in there. So you guys get to see. Say it again.
And students deals as well. We look at students.
Oh yeah, absolutely. So we invite people to submit their deals, and of course we anonymize everything. But the idea is we're looking at real live companies with real sellers, real brokers, real partners, all of that stuff, and we're evaluating those deals. And that's all found in Dealmaker Academy, where you get to see a live example and live training on how we think, how we act, and how we behave collectively as deal makers when we're analyzing deals. So it's Dealmaker Academy. We're pretty excited about how awesome that program is.
And we also, as part of that membership, we meet up 3 or 4 times a year in like a mastermind setting. Our last one was in Miami in December. We were going to do one in a couple of weeks, but obviously we had to cancel it because of the travel restrictions. But as soon as those lifted, we'll be announcing new dates, probably one in London, and I think Adam probably one in Chicago sometime later this year.
Yeah, we had some planned for late spring here, but obviously we're all dealing with a bit of a homebound situation, both in the UK and here in the US. So we thought it was best to just put those on hold until we had a good figuring of what can happen. So those meetups are free for anyone who's in the academy. For people who are Dealmaker CEO members, they get a chance to come for a pretty discounted ticket rate. We're looking for people who are actually working on their Dealmaker journeys. We're not necessarily pulling in people off the street. We want people committed to becoming deal makers, just like us. Generally speaking, it's a full day of teaching and coaching and training from Carl and I, plus a few of our other students and coaches who have done deals. So it's a pretty awesome event. We hand out tombstones to people who have finished deals, which is fabulous. I've only broken mine like 3 times, Carl. So you're going to have to get me yet another one for buying your business. So, so here we are.
So, hey, next question from Andrew. As an owner investor versus an owner operator, we touched on that before. What are the typical weekly, monthly, and quarterly job responsibilities that you have as an investor in a small business?
Yeah. So, I mean, owner investor is easy. I'm looking strategically, what are the really big needle movers in the business? Am I looking for bolt-ons or other acquisitions that can help scale the business? And more importantly, I'm just looking at the financials. What's happening on a monthly basis? Is the business trending up, down, or flat? And what are the levers in the business I can pull? That's an investor. I'm not actually managing schedules and who's coming into work, when they're coming into the work, new staff, firing staff. I've got a GM in the business as an owner investor who's doing all that stuff for me. So I can just focus on the 30,000 foot view, and I don't have to worry about any of that day-to-day stuff. We're talking maybe an hour a week of work, maybe some weeks none. It's really about, what do my financials tell me? What are my communications with my GM telling me, say on a weekly basis? Other than that, they're free to run. As an owner operator, you're the GM. You're managing the day-to-day. You're making sure people are showing up. They've got their tasks. They've got their assignments, and they're out there accomplishing what they need to accomplish to move the business forward. It's a lot harder to kind of lift yourself above the day-to-day and look around and think strategically at what's going to happen next in this business. How am I going to advance my business, build my empire, and take frankly my ownership interest to the next level? How am I going to take a 2 million business and make it a 3 million or a 4 million or a 5 million, right? How am I going to advance my interest? As an investor, I got someone to worry about the little things, and I can worry about the big things. And that's if you want to be involved at the strategic level. If you've got a really good leadership team in place in a business, you can just look at financials just to make sure they're not screwing up. Make sure your accountant's auditing the numbers so no one's stealing from you. And then finally, figure out what you're going to do with all the checks they're sending you on a monthly basis. That's an owner's investor's opportunity.
Okay.
Cool. Next question here is from Lisa Carl. I understand the concept of when buying a business, the cash in the bank belongs to the business. and this can be leveraged to buy the business.
Yes.
However, further along in the Dealmaker CEO training, during wealth creation, the cash in the business is then treated as my money again to take out of the business when selling. Carl, you say when the cash is yours, you say the cash is yours, but that's the opposite of saying the cash belongs to the business. Could you provide an explanation on why these are two opposing statements?
Yeah, sure. So I'm going to break this into two parts. The first part is when you value a business, we're buying a business that needs to have a certain amount of cash inside of it so that we can comfortably trade it. And generally, we're looking at around 10% or so of the annual revenue. So if you're buying a business that's got $1 million in revenues, you want to take the business over with circa $100,000 in the bank so that you can trade it as working capital. If that business had $200,000 in it, then that extra 100,000, you're right, that money belongs to the seller. So you're having to give them that cash as well as part of the deal, but you can use that cash obviously as part of your financing mix. So if you're the owner of the business, any surplus cash that you have, it's an asset that belongs to you. I think what Lisa's actually asking is when you're buying a business as part of the wealth creation, sometimes if you raise more financing than is actually required to make a closing payment, you can come up with what we call a surplus cash amount. And if you want to, you can take that money out. So let's say you're buying a business for $500,000, you're paying 200,000 down, and you've got a 300,000 seller financing note, and you raise $300,000 in financing, then you're going to use 200 of that to pay the seller. You might have $50,000 in closing costs. You might be paying the broker if you've got the broker on your side, but you're going to be paying for your contingent CPN, your contingent attorney as well, any consultants that you've used to help you with the deal. So let's say that's 50K, then there's 50K left. And you might say, well, okay, that's cash that the business doesn't need. It's cash that the seller doesn't need. I've paid all my fees. I can take that money out and I can do what I want with it. I don't personally do that. I'd rather keep the money in the business and use it to grow, because obviously as you grow the business and you grow the profit, when you sell that business at a multiple of the profit, you're multiplying your wealth creation by keeping that money in the business and having it work for you.
Yeah, absolutely. Cash is an asset that can go both directions depending on which side you are on.
Yeah.
So we've got some questions here in the chat. So I'll just bang through a couple. Kenneth asked us, during these times of social distancing, would appreciate some advice on building rapport with owners and brokers virtually in lieu of in person. I'll take this one, Carl. This one's easy. We're doing it right now. We're talking video conferencing. So while we're streaming this on YouTube Live right now, we're simply using Zoom, which is one of the more popular video conferencing apps or programs. You can do this at any point. Get on the phone, take your time, ask good questions. I'm on the phone with a banker yesterday, early evening, and I'm talking to the guy. He's in the yard chasing his 3-year-old. He's in the same situation so many people are in right now with the shut-in. People are just looking to connect on a human level. So have a conversation. How are things? What are you doing? You got any crazy kids? Any crazy pets? Are you getting stir crazy? How are things in your town? And just play off of it. You can always look to try to see the person through Skype or any of those other technologies. I mean, you can make calls through Facebook Messenger now. So there's a lot of technology out there that allow you to connect with each other in ways we haven't before. And again, Carl is roughly 4,000 miles away from where I sit right now, but I can see him and you guys can see us. And that's the beauty of the technology. To me, that in this world of social distancing is the best way to build rapport.
And if you want a really awesome tip to instantly build massive rapport with somebody that you're speaking to, is if you're targeting a business that, let's say it's owned by a baby boomer, somebody in their 60s or 70s that's looking to retire. And, we might argue that those people are a bit more vulnerable right now. When you call them up, before you even talk about the business, to Adam's point, ask them how they are. If they're close to you, if they're in your town or city, ask them, is there anything you can do to help them? Can you go and get them a bag of groceries? Are you able to go and pick up some medication for them? That will build such incredible rapport. When you eventually make an offer on that business, how differently is that offer going to be received from that friendship that you've built up by asking a 10-second question? 99 times out of 100, they're going to say, thanks, Adam. I'm absolutely fine. My son came around the other day. They're taking good care of us. But, what a great thing to ask. Thank you very much for thinking about me and caring about me. That builds a level of rapport that will pay dividends for you at some point in the future when you start to negotiate an offer.
Yeah, absolutely. Let's see here. That was Ken's question. Glenn, he's asked, brokers, owners are insistent on cash up front. Essentially, owners want some cash and someone to help pay off their existing debts, whether it's SBA or otherwise. What happens is, what happens if there's a need for cash input? Kind of a confusing question there, but
yeah. So I think one of the things I picked out of that,
maybe I missed a line in there somewhere, but Glenn's seen a lot of $1.5 to $2 million businesses out there. They need cash. We either find capital partners. You find a capital partner. Anyone finds a capital partner. I think I think the goal is, how do we move forward as collective buyers? If we're focused on using none of our money, the simple way is, how do we go find people who have money and are willing to invest in small businesses? There's plenty of them out there. It's a matter of pitching them and making sure they understand the opportunities.
The other point to that, Adam, is that I picked up in the question is, if you're buying a business that's got liabilities inside of it, and the seller wants a closing payment so he can pay down those liabilities, that's crazy. Just don't pay the closing payment, but then you, as the new owner, just assume the liabilities that are in the business. So if you're buying a business that's got $500,000 of liabilities, and the seller wants $500,000 down so he can retire that debt, pay him $0 down, and you assume those liabilities inside of the business. It's cash flow neutral for the seller, and it means you don't have to go out and raise all that financing. It's crazy.
Yeah, and I'll say this. Not your tax advisor or anyone else's tax advisor. Sometimes forgiveness of debt or acceptance of debt, it's called COD income. They'll have to pay taxes on that. So you might have to structure that in your deal. Certainly talk with your CPA or financial advisor on how to best cover that. But broadly, capital required for deals shouldn't be an impediment. How do you rework the deal to really understand what the seller needs? And it's a matter of diving in. And if it's truly a situation where cash is involved, then there's people out there you can build a network with to find that capital. So back to some of the questions we got in email, Carl. So we answered, the last one you answered was from Lisa about being on both sides of the cash and how that's possible. So the next one's from Adlea. What do you say to asset-based lenders when you are telling them about a deal and they ask how much money I am personally putting into the deal? I've said I'm looking to do a leverage buyout. Is that correct? What else do I say?
Yeah, so I never ever use the word leverage buyout. The word leverage buyout is a Wall Street term. I used it a lot back in my corporate career. When you're talking to a seller, then you would always say that you're looking to acquire the business with a mix of equity, debt, and seller financing. It's important to tease seller financing right in those kind of early conversations, because if the seller's not prepared to defer any of the purchase price, then simply move on and go to another deal that you have in your funnel. Remember, it's a numbers game. You can't pick one random deal and expect that deal to close as an LBO. You've got to have multiple deals in your pipeline. And then obviously as business buyers, we want to buy the business and own 100% of it. So if we're not having to finance that deal with any equity partners, then it means we can keep the entire 100%. But if you find a great business that needs some capital that you can't get from debt and you can't get from seller financing, an investor has to come in and partner with you, then it's better to own, say, 75% of a business and have an equity partner with the other 25% than own 100% of nothing. And remember, that equity partner, if you use an angel investor, that person is going to have some chops in the industry that you're looking to buy in. They might have a network that they can leverage for business development. They might have some really good skills that they can deploy into the business that the business doesn't have. One of the most common skills that you'll see is from an angel investor is they'll become like your virtual CFO. So every business normally has a financial controller who manages kind of the day-to-day finances of the business, but it's very rare for a small business under, say, $5 million that you have a CFO that's looking at the financials of the business strategically, and somebody that can also help, with an acquisition, can help with doing bolt-ons, and can also help, raising more capital in the future, and then obviously selling the business. So having an equity investor in your deal, can also be a good thing rather than a bad thing.
Yeah, absolutely. And to even say it a different way, you've touched on it. You said rather own 75% of a deal than 100% of nothing. I'd even say I'd rather own 10% of a deal than 100% of nothing. Any percentage is better than no percentage. And so when I look at how I do deals and how we do deals, Carl, and what we look to accomplish, we're always trying to do the deal. I can think of deals right now where they're not the right deals for you or I, but we can bring in outside financial partners. I'd love to have 5% of some of these deals. We're talking about several $1 million in earnings on the bottom line. Why wouldn't we want to have a small percentage of that if someone else is willing to take the financial risk to support the acquisition?
Awesome. No, completely agree. Alrighty. Question for you. I've been going through the Dealmaker Launchpad program. I have even found a few businesses that met my met my criteria. The business requires me to sign an NDA, and they also want my financial information. My current financial situation is not that rosy. How should I respond to these businesses? This is from Burke.
Well, Burke, I think it depends on where you are in the process, right? If they've not even, if you're still at the point of signing an NDA, it means you've not even looked at financials yet. You've not really seen any true information. One response is probably a little bit more aggressive is to say, look, as of right now, I have no understanding of what the business is actually worth, given I don't have any perception as to the real financial performance of the company, historic numbers, or anything like that. So it's hard for me to share any of my financial information without truly understanding this is a business that has any value outside of your word. Other ways to say this are, if they bring in like tire kicker language or things like that, we have this to prevent tire kickers. Well, simple response is, well, I'm tired of sellers who are tire kickers themselves and aren't serious sellers. Would you, in order for me to understand that you're serious, I need to sign a good faith from you in sharing your information that you're actually willing to do a deal. So things can be played back and forth on that. But at the end of the day, there's a lot of ways you can work around it. Sometimes I'll just leave that information blank and it doesn't really do anything. People just send things along as soon as they have that NDA signed. So, Carl, do you have any other advice for people beyond that?
No, 100% agree with you there. Unbelievable.
Great. So,
any more questions in the chat, Adam?
Let's see here. I think Burke might be in the chat. I don't know if that's Burke or not, but how do you find angel investors?
So the Google angel investors, and then put comma location or comma sector. There are thousands and thousands and thousands of them out there. And there's also angel investment networks. So they work a little bit like crowdfunding platforms. Crowdfunding is a great way to raise equity for a deal, but typically once you've purchased it, you can't crowdfund to buy a business, but you can crowdfund for like a second 90-day closing payment or to raise more capital going forward. But if there's loads of angel investing sites, in fact, in Dealmaker CEO, there's a Rolodex of them. So you can go on there and you can submit your deal. We include the pitch deck template that you can fill in about your deal, about the numbers and the business model and all those different things. And then you can upload it, and then you can start having conversations with angel investors. And remember, with an angel investor, there's two things that you want. A, you want cash so that you can close the deal, but B, you want a sparring partner. As I mentioned before, you want somebody that's got some chops and can add significant value to the business.
Yeah, nothing to add there. Let's see, other questions. Hi, gents. Given the current crisis and retiring baby boomer trend and use of new tech, what type of companies will we see desirable to acquire, and how do we forecast the future sustainability of them? We answered this a little bit at the beginning, but think about things I think about are we're going to see an uptick in nationalism in terms of manufacturing and distribution and things like that. I think people have realized there's some risk in goods and services coming from one country predominantly, and that's China. And what happens if the supply chain suffers any kind of pandemic or other significant interruption? So I see opportunity there. But for me, at the end of the day, businesses with good foundations shouldn't be impacted. Carl talked about logistics businesses, transportation businesses. I think there's a whole range of industries. Professional services. I think someone else asked a question about professional services questions. What are our thoughts on those right now? I think the same thing, right? If it's good business with good foundation, listen, people are going to want to continue working with them, whether it's a digital marketing agency, whether it's an accounting company, whether it's a law practice or solicitor if you're in the UK. I think there's just going to be plenty of opportunity, regardless of the industry. It's finding the right one. Because remember, even as businesses might be wobbling right now, we've seen just a massive amount of stimulus come in from the governments, or will be coming in. I think that creates a lot of stabilization, especially in the small business space. So a wobble means the prices get lower, and you've got the backdrop of kind of government support in many of these cases. So
really interesting question, Adam. I'm just looking in the chat. Lisa's asked, would love to have been a fly on the wall. You both were negotiating your merger. So actually, it wasn't a merger, Lisa. It was an acquisition. So the division of Agora that Adam runs acquired Ninja, and I'll tell you that negotiation lasted.
It was super boring, wouldn't you say?
Was it 3 minutes or 5? I can't remember.
Listen, really we'll assume we talked about other things for the first 2 minutes, talked for a minute about the deal, and then switched to other things for the remaining 2 minutes. So we'll call it 5.
Yeah. So probably one of the easiest negotiations that I've ever been through. The challenge was the legal process. Yeah. Obviously, Agora's $1 billion company, and they had an army of lawyers, and I just had my guy. So the legal process took a little bit longer, but no, it was an easy deal. It was an easy deal, and I remember the day. I remember the day really, really well. Alrighty, I think we've got 15 minutes left, Adam. So
let's crack into some of these questions. I think next one's for me. So Thomas asked, how do I talk to financing institutional people in the first contact when my intention is to do nothing down in an LBO? Well, as Carl said earlier, you never want to say leverage buyout. You want to say things, my acquisition strategy relies predominantly on debt financing, things like that. But I wouldn't even get into that, right? When I'm talking with financiers or, banks or anything like that, I just want them to know who I am. I want them to know I'm serious. I want them to know that I'm a legitimate threat in the acquisition market. So most of the time I'm doing subtle credibility builds. Here's what I've done. Here's what I've been. Here's a fun story or a humorous story. I'm building relationships. I'm not going straight to I need your money. I need it right now. Here's a deal I'm looking to buy and I need you to tell me what's going on. No, I'm focused on the relationship first. I don't get into the weeds of deals really at all. If I do in a first call, it's normally after the 30-minute mark. We're well into a relationship. Again, I know that they've been chasing their 3-year-old around the yard, that they've got a 10-year-old at home. They've got a split shift time with their wife or their husband while both of them are on conference calls and they're dealing with everyone being shut in and just using the current day and scenario. So I think the thing at the very core is, listen, it's just a relationship build. It's just like you're meeting a friend or you're meeting someone you might be interested in dating. You've got to build a relationship. You've got to learn about them and they've got to learn about you. And you've got to be transparent and honest about what your goals are, your hopes are, your dreams are, all that kind of stuff. They will gravitate towards them because people are inspired by the hopes and dreams of others. Carl and I have a really big vision for how we could potentially impact the bigger small business acquisition market, right? And people are inspired by that. People want to be involved with it. And I think for you, it's no different. How can you share your hopes, dreams, ambitions, and goals? People will gravitate towards it.
Yep. Interesting question in the chat from Jeremy. Jeremy, I'm a Canadian living in Cancun, Mexico. Have you guys done deals in Mexico? So I know, Adam, you've done a ton of real estate.
I've got a piece of 3 properties down that way.
So Adam's a real estate hustler on the side. He's got real estate deals down there. I've never done. I bought businesses in Mexico on behalf of US corporates. I've never done a leverage buyout in Mexico. I've only ever really done deals personally in the USA, UK, Canada, and Australia, and I focus on kind of westernized markets where you've got strong seller financing mindsets, strong entrepreneurial culture, and you've got quite a mature kind of acquisition financing market. So take China, for example. It's virtually impossible to do a leverage buyout in China. A, there's no financing. B, there's no credit. And C, nobody will even do business with you in China if you haven't been and stayed in their house for 3 months. Countries like Africa, a lot of parts of Latin America, Southeast Asia, although Singapore's a great market for LBOs, and Kuala Lumpur as well, and also Japan. But a lot of these kind of emerging nations, they're still a ways behind in terms of having the market sophistication for doing LBOs. I'm not saying you can't do a deal from Mexico. I've just never done it. I think if you bought a business in Canada first and then used the Canadian acquisition to do a bolt-on acquisition of a Mexican subsidiary, then that is definitely something that you could do. But Jeremy, if you want to be an owner investor like Adam and I, and you live in Cancun, you can still buy businesses in the US and Canada, and then you can invest those deals remotely.
Yeah, absolutely. Let's see, one more question. Austin's asked about the deal I referenced in the Confessions of a Dealmaker email yesterday. What was the sales price? How many hours are the owners going to put in, and what are they paid? I can't give any specifics of the deal. That would just not be that would not be good for me to share that level.
And you'd probably get sued because you're breaching.
Yeah, I mean, there's all kinds of confidentiality things around that, so that's why I didn't give any exact numbers on those. But yeah, so really cool deal, really cool situation. It just goes to speak to the kind of possible motivations people will have right now and the opportunity for seller financing. So there's plenty of deals out there. You just gotta keep taking shots, right? You gotta keep originating deals. The more you originate and the better you get at evaluating the quality of the deal and the better relationship you can build, the more likely you are to get a deal or an opportunity somewhat as sweet as that, if you will. But again, let me be clear. It's a win-win-win for everyone in those kind of situations. Everybody's walking away feeling like they came out ahead. If they don't, it's a deal not worth doing, period. And that's the start, stop, finish of it at all. So anyways, next question, Carl. We've got, say, 8 minutes or so, and I see 1, 2, 3, 4, 5 more we want to bang through, 6 more we want to bang through. Can we do it? A little lightning round action?
Yeah.
All right, great. First one from Eric. What is your favorite way to generate deal flow? Or is your favorite way to generate deal flow, still the direct approach via direct mail letter? Go.
Yeah. So me, I've started to favor a lot more recently, more networking. So calling deal intermediaries, leveraging social media, because you still get off-market deals doing that way. I still prefer the direct approach over, say, contacting brokers. So my top 4 would be networking, social media, direct approach, and then brokers would be number 4. But I only look at broker deals if they've been listed at least 12 months, 6 months, absolute minimum.
Yeah, great. Next question from Steve. Probably a question, it's another coronavirus one, but still, is now a good time to buy a business? And are financial firms willing to give asset-based loans at this time? In our experience, your experience?
Absolutely. Yeah. But as I said before, go find 10 businesses in a space that you understand and you're passionate about. Build 10 great relationships with those sellers and make 10 100% seller financing offers. At least one of them will say yes. But you've got to have those really strong relationships first.
Perfect. Next question from Raj. What valuation range is best for balance sheet financing? Kind of a broad question.
Do you want to answer that, or do you want me to answer it?
No, you can fire away on this one. I'll get the next.
So for balance sheet financing, I think what Rajal is talking about is the balance sheet method, because he's talking about valuation. So normally you use a balance sheet method valuation when you've got a business that's really kind of like earnings poor, but it's asset rich. So you've got a big healthy balance sheet where the assets minus the liabilities is, say, $1 million, but the business is only doing 100 grand in earnings. So to value that business, you take the value of the balance sheet, which is the net asset value or the shareholders' funds, however we phrase it. There's loads of different phrases for that. And then you'd add a little kind of portion in there as well for goodwill. But it's interesting. If a seller says to you, hey, my balance sheet's worth $1 million, actually it's not, because one of the number one exit strategy for most small business owners in the United States is to close the door and turn off the lights, and they'll liquidate the balance sheet in their business to generate some cash to retire. But the problem is, if you've got assets on your balance sheet, you're not going to sell them for 100 cents on the dollar. If you're fire sailing fixed assets, you're lucky if you get 50 cents on the dollar. And you can bet that all the liabilities that you've got to pay back, bank loans, overdrafts, hire purchase equipment, taxes due, you're pretty much paying 100 cents on the dollar for those. So in a lot of cases, the value of the balance sheet is a lot less. The other element to that is for balance sheet financing of assets, again, we're typically looking at around 80% for receivables that are younger than 90 days. We're looking at generally 70-75% on real estate, 30 to 50% on inventory, depending on what it is. If it's perishable, you won't get anything. If these are engineering components going into an Airbus A380 with a 20-year order book, you might get 50, 60, 70% on that. But the only way to find out is get the asset lists from the seller, offer them up to the financiers in the Rolodex, and they'll tell you kind of what the bid ranges are going to be.
Perfect.
Question from Richard Adam. How does one structure a transaction with as little cash down as can be done without chasing away the seller?
It all comes back to the why. If you know what the seller's motivations are and you can build the relationship with them and wrap their why around. Listen, not all sellers are going to work this way. Not all sellers are going to be able to accept a small cash payment or no cash payment. And that means you're going to have to raise some kind of financing against the balance sheet, which conveniently Carl was just answering about, right? So at the end of the day, it comes back to their why, understanding what their motivations are, and finally, and most important, seeing how you can work with them through that relationship to come up with a deal that will have as little cash as closing as possible. And sometimes that means overpaying for the business, right? Hey, I'm not going to pay a 2.5 multiple. I'm going to pay a 5x multiple. Are you good with paying a 5x multiple, Carl?
I am, if I can pay for it over 10 years.
Boom, right? So me too. I'm good paying a 20x multiple if I can pay for it over 40, right? The idea is multiple is just a number. Valuation is just a number. And all of those can be played with in a manner that suits your needs as the buyer and the needs of the seller. And of course, any intermediaries who are involved, brokers, accountants, lawyers, whomever. So at the end of the day, it comes back to the why of the seller and the relationship you're able to build.
Yep.
All right, Carl, we got 2 minutes. We got 2 questions. Can we bang them out?
Yeah.
Let's do it.
What's the next one?
Lawyers, accountants on contingency. How do I build trust, and how do I work out details with them once the trust is established? So even once it's the rapport is built and they get paid hourly, how do we convince them to frankly be a contingency kind of partner of ours, so to speak?
Okay, perfect. So 2 things you need to do. So the first thing is, you're right, you've got to build that relationship. You've got to convince them that you're a credible buyer. But more importantly, you have to have a deal that you've got a signed LOI to buy it with exclusivity, and any financing that the deal needs, you've got the term sheets from the financiers. So basically then it's just primarily a due diligence exercise and a papering of the deal exercise. And I would say 80% of the deals that I've done that have got to that stage, they've closed. So the obvious risk from the advisor is if the deal doesn't close, they don't get their money. So obviously you have to offer them more money as a contingent fee that they would generally get working by the hour. But then also, if the deal was to abort, worst case scenario, you can just roll that fee into the next deal. So the advisor fees are always a very small percentage of the total economics of the deal. So if you were promising a 20,000 fee to a lawyer and the deal aborted, and then you find another deal, you just pay them 40 from the cash flows of the business, even if you've got to pay them over several months.
Yeah, absolutely. So before we get to the last question, I just want to say, guys, if you haven't started your deal making journey and you're interested in doing it, we've got Carl's business buying blueprint. It's free for you. There's nothing you guys have to pay for. Just click the link in the comments below or in the description of the video below, and we'll have the link out there for you. But more importantly than anything, we want you guys to succeed on your deal making journey. And if you have questions, keep hitting us up. We'll do more of these video mailbags. But last question, it's actually coming from the chat here in YouTube. So thanks guys for all your questions. Thanks for watching. Thanks for interacting with us. And Lisa, next time you'll be a fly in the wall when Carl and I do a deal. I'm sure of it. I don't know what other company you might have, Carl, for me to buy, but we'll see what we can do. So last question, Jonathan, are accountants the best lead source at this time? And I'll take this one, Carl. The answer is yes and no. Everyone's a good lead source. Build your network, accountants, lawyers, wealth managers, any of them. Find people who work in around businesses. If you've got salesmen who touch a lot of different businesses, build networks with them because they'll understand what's happening in the network or area they sell to, right? Anyone who deals with businesses in any capacity are the best source for leads. Because at the end of the day, deal making is a relationship game. That's what it is. It's what Carl has built his training around. It's what we do practically in our day-to-day lives as we look to identify companies to acquire them for ourselves. And it's what you should do. Build your network. I think in the last probably month, I've spoken to give or take 15 different banks. different bankers, commercial lenders, SBA lenders, just building relationships. Not all of them are going to work with me on a deal at this time or in the future, but the bigger network I have, the better off I'll be. I've got it to the point where I'm building relationships where they're then introducing me to like a tier 2 person, meaning someone one step removed from me. And the only way I would have ever met them is if I'd built a relationship with the first person. Literally yesterday morning, I had a broker send out 3 introductions to different banks just to see if I could build a relationship. So, Carl, I don't know if you have anything to add on this before we get out of here.
No, absolutely. This is a relationship business, guys. The stronger you are at building relationships and building rapport, the easier this is with sellers, with brokers, with lawyers, with CPAs, with financiers, everybody. The stronger the relationships you build, the easier this is.
Yeah, absolutely. So guys, again, if you're interested in Carl Allen's business buying blueprint, go ahead and get it in the description or the link below in the comments. We're looking forward to continue to do this, whether it's here, Facebook, LinkedIn. We're gonna keep mixing it up, keep you guys on your toes. Remember, guys, you're only one deal away.
You're only one deal away, and if we've not answered your question today, I know we got hundreds and hundreds of questions in. We'll keep them for next time. So keep sending them in, and we'll see you guys soon. Have a great weekend. Stay safe. Stay healthy. We're going to get through this. Just be resourceful, guys. Look after your families, and we'll see you soon. Until then, bye for now.